JK Cement Investment Analysis Report. Overview. JK Cement, also known as JKCE, is a leading player in the cement sector, demonstrating consistent operational performance and strategic expansions. The company is well positioned for long-term growth, supported by capacity expansions, cost optimization, and a pan-India presence. The stock is currently trading at 6,393 rupees, with a target price of 7,300 rupees, implying a 14% upside. This makes it a buy recommendation. Key investment highlights. Number 1. Strong execution and expansion plans. Capacity expansion. JK Cement aims to increase its production capacity from around 25 million tons per annum in financial year 25 to 50 million tons per annum by financial year 30. This will be driven by greenfield and brownfield expansions, including plants in Buxar, Jaisalmer, Mudappur, and Panna. Pan-India presence. The company is entering eastern markets like Bihar and Odisha through the upcoming Buxar plant, strengthening geographic diversification. Resource security. JK Cement has secured a 40-year limestone supply agreement with GMDC, covering reserves of 250 million tons, and has been allocated 2 coal blocks, Mayan and west of Shadal, ensuring fuel security. Cost efficiency and sustainability initiatives. Cost savings. The company achieved savings of 40 to 50 rupees per ton in financial year 25, with further savings of 75 rupees per ton expected in the coming quarters. Green energy. JK Cement is increasing its share of renewable energy, targeting 35% green power by financial year 30, and focusing on blended cement to improve margins. CO2 emission reduction. The company is targeting a 22% reduction in emissions from financial year 20 levels, and a 10% reduction from financial year 25. Number 3. Financial performance and outlook. Revenue growth. A 13% compound annual growth rate is expected between financial years 25 and 28, driven by 11% volume growth and stable pricing. Profitability improvement. EBITDA per ton is projected to rise from 1,010 rupees in financial year 25 to 1,280 rupees by financial year 28. Operating profit margins are expected to reach 20 to 21% by financial years 27 and 28. Profit after tax is projected to grow at a 31% CAGR during this period. Strong cash flow. Cumulative operating cash flow of 81 billion rupees is expected between financial years 26 and 28, against a capital expenditure of 48 billion rupees, resulting in declining net debt. Number 4. Valuation and target price. The stock is currently trading at 19 times and 16 times EV to EBITDA for financial years 26 and 27, respectively, which is below its peak valuation. Target price. Valued at 18 times June 27 expected EV to EBITDA. The target price is set at 7,250 rupees, indicating around 14% upside. Return ratios. Return on equity and return on capital employed are expected to improve to approximately 19 and 13% respectively by financial year 27, up from 13 and 10% in financial year 25. Near-term challenges. Sluggish demand in the first quarter of financial year 26. Construction activity has been impacted by heat waves and early rains. Pricing pressure. Cement prices have remained range-bound in the north and central markets, which account for around 80% of the company's capacity. However, medium to long-term demand remains robust, supported by continued infrastructure and housing growth. Key charts and metrics. Capacity expansion from financial year 16 to 30. gray cement capacity is expected to grow from 10.5 million tons per annum in financial year 16 to 51.3 million tons per annum by financial year 30. Utilization is expected to exceed 70% between financial years 26 and 28. EBITDA growth estimated at 20% compound annual growth rate from financial year 25 to 28, reaching 35.2 billion rupees by financial year 28. Debt profile. Net debt is expected to peak at 42 billion rupees in financial year 26 and fall to 27 billion rupees by financial year 28. Net debt to EBITDA is projected to fall below 1.0x by financial year 28, from 2.0x in financial year 25. Investment recommendation. Buy target price 7,300 rupees, implying a 14% upside. Why? Strong volume growth from capacity expansion. Cost efficiency driving margin improvement. Improving return ratios and debt reduction. Attractive valuation at 18 times EV to EBITDA for financial year 27. Risks. Prolonged weak demand due to macroeconomic factors. Delays in expansion projects. Conclusion. JK Cement is a structurally strong player in the cement sector. With a clear growth roadmap, cost leadership, and improving financial metrics, the stock offers a compelling risk-reward proposition for long-term investors.